Hi guys, right, so this is the mock for the question 16 for the mock. I'm just going to go through the key points. Right, Koeman Co. So by way of introduction, the date is the 1st of July, X5. So you have a new client. Every time you see a new client, again, just standard marks, scream out audit risk. That's the point. As soon as you see audit a new client, you immediately what should scream out at you is the fact that there is an audit risk over here. The current year end is the 31st of August 2005. So some of the issues, and there's nothing wrong with, depending on how systems based, many organizations have to manage, will have a system of recognizing revenue or taking in revenue. So you just have to work with it. Our aim is just to make sure that only the accrued revenue for that year is reported. So it says the company recognizes revenue when the customer places an order. So we know that revenues should only be recognized when risks and rewards have been transferred to the client. So let's read a bit more. So it tells us that 95% of orders are processed and dispatched the day they are received. So we see, okay, there's a high probability that the orders, if you like, will correlate strongly with revenue for that period. It says the client has also decided to reduce the allowance for doubtful debts from 4% to 2% because credit control have additional staff. So with inventory, they initially valued the stock, but then what they do is they observe inventory older than 180 days and they write that down by 20%. So you should already have warning bells literally telling you that, well, all inventory pre 180 days, if you like, is suspiciously overstated. Right, so we will want to carry out serious analysis, intense analysis, or inventory days on structured, targeted analysis of risky inventory, slow-moving inventory, pre 180 days anyway. This is one issue here because it is likely that inventory between 90 days and 180 days. I'm even going to go as far. You can almost feel free. You can go. You suspect, depending on what you observe as the normal inventory cycle. So if the normal inventory cycle is 35 days. Anything between 35 days and 180 days is potentially overstated, might be obsolete. That's the first issue. The second issue here is that even this inventory post 180 days, I'm already answering the question, I should really read this thing through, is that this thing post 180 days is only written down by 20%. Well, IAS 2 says we write down inventory lower of cost and NRV. Just because you write down your NRV by 20% doesn't mean it's still lower than cost. It might actually be much lower um, than cost. So you have to do some testing on inventory older than 180 days to find out whether or not it's actually entirely worthless and to see if it's actually moving. Okay, anyway, the directors have agreed to pay themselves a profit related to bonus for the year. So that should scream out that if they're going to pay themselves, a bonus, a profit, forgive me, pay themselves a profit related bonus, which means that uh, if you're basing bonuses based on profits, then you need to have professional skepticism immediately because the argument here is they will do everything to inflate their profit figures. So this is just a general sort of professional skepticism, potential for inflating profits because they wish to give themselves a bonus. So they give you some numbers, which of course you've looked at, and then ask you to perform the ratios for these numbers. Right. So um, so you can do all the ratios. I did all of mine. Um, I tend not to look at the answers so much because it's very possible that we might have slightly different answers, and you will still be looking at the answers and referencing this as well. So the first question says, explain the purpose of 3 contents required for audit documentation. So what I did was to just get us an actual what a working paper looks like, so you can actually see everything. I will send this to you via email as well. See what these working papers look like. You can see that a classic working paper will have the name of the client, who's prepared it, when it was completed, the reviewer, the date it was reviewed, what the objectives are, what your results are, and some kind of conclusion. So this is what a classic working paper looks like. And behind this paper, you will have the evidence. Maybe you've done some bank circularizations, and or you have done a cutoff or whatever it is. Behind this, you will have copies of the invoices that you have worked on. And that's kind of the key point. So you could have picked any of the three things from here: objective, what your results are, who the reviewer is, the preparer, the client name, things like that, a conclusion, if you like. Right, let's carry on. So then it wants us to work on these, it says us to calculate this ratio, these ratios. I think I already suspected, I said this already, given that these directors are quite, their bonuses are related to their profitability, we can see quite a big jump here. So again, unless you can find some real market growth, so growth in the market or a reason to increase prices, you shouldn't be seeing this kind of jump. I mean, this is a big jump, isn't it? So what you're really saying here is that either your prices have gone up or your costs have come down, or it might simply be because you have. So you're really interested in some real serious cutoff testing to see whether or not in revenue has been, only revenue for that period has been included in that period. It is interesting that you're having such high profits, but yet, I mean, it's possible that you can have an increase in your inventory holding period. You could have really bought a lot of stock to prepare for this increase in growth. So it's very possible, of course. And it is taking longer. So yes, you might be also, they're not irrational, but they are causes for concern. The argument is you might be selling to a really big customer who is giving you longer days. So that's possible as well. So they're not irrational. And you're, in terms of trying to just improve your cash flow, you're thinking along these lines. And your current ratio has fallen as well. So the fact that your inventory is increasing, but your current ratio is falling, is making us wonder that that really the issue here is a cash issue, because current ratio is made up of inventory, debtors, and cash, but these are going up, and yet the overall ratio is coming down. So it means that either your current liabilities is really severely going up, or cash is really bringing this down. So, it gives you a way of thinking about it. All right, so they asked you to talk about a couple of the risks. I'm sure you've tried, of course, and written yours and then put yours together. The risks typically, like I say, jump out at you. I've just picked a few. I've talked about the new client in terms of, so every time you get that client question straight away, you have to write new client, increase in detection risk due to potential errors. Because it's the first time you're doing it. Responses typically should be about you allowing your most experienced auditors to sampling should increase in general, should have larger sample sizes, you should have more time for the audit, and it should typically be exposed to maybe some kind of engagement quality control review, as it's a first time audit, even if it's not listed. So all those will earn you marks in that regard. Revenue overstatement. So so what they do here is that, again, revenue potentially overstated because they recognize when. So that means that 5% of the goods are not dispatched on that day. So there's potential overstatement there. So it's possible that those are overstated, and so and therefore that needs to be assessed anyway. Something I haven't written here is the fact that because there is a bonus risk anyway, because profitability is linked, it probably should be written separately, to be fair, because profitability is linked to profit, and because bonuses are linked to profitability, there is also a cutoff risk. With the managers trying to inflate revenue. So I talk here about cutoff testing, expand the cutoff testing in general, and then of course those orders, those 5% orders, should all be reviewed really, I mean, they can't be that many. So whether you talk about it, they should be reviewed to ensure that they are not in the year. So literally the 5% orders around the last week of the year shouldn't be in that. I mean, I suppose you could also look at generally how they manage those 5% orders and when they recognize them, whether they go into revenue straight away and whether there's a journal. It will be quite repetitive. It'd be interesting to see how they every cycle journal out those 5% um, additional orders and not recognize them as revenue. So there is also a risk that trade receivables are overstated as the provision has been reduced from 4%. So the only one of the better ways to assess this is to assess after-date cash. So of slow-moving receivables, forgive me, um, receivables. So because that's the point, the argument here is someone's telling you that, listen, I'm reducing my provisions. So you're saying, well, what is that? What's going on with debts that were owed at the year end, and assess that. And if it truly has been received, and so that's really your way of looking at it. So I talk about that here. Yes, this fact that GP has increased potential overstatement of revenue. So cutoff testing, reversal of all orders recorded as revenue. And then, of course, I talked earlier on about the inventory overstatement. Recognize inventory at the lower of cost in NRV. 20% will still be too high. I talked about almost needing to stratify your inventory into two parts: the post 180 days to assess, and then the pre 180 days to assess as well. Right. Then I think the question, once they want us to talk about substantive procedures for year-end inventory balance. So again, what should drive this is your understanding of what the assertions are. So the key assertions, of course, for inventory in general are valuation, completeness, existence. To a certain extent, those are the main ones. So what we are trying to do in terms of valuation, again, is to identify slow-moving inventory for write-down. And again, it's not only past the 180 days that we write off. And it does seem likely that the inventory will not be selling for higher than costs less 20%. And again, I've written here, it is also likely that the inventory has not moved for up to 180 days and is currently being held at cost value. So again, like I said, I think it's important, this initial analysis of inventory days across key products in the organization, obtain the inventory lists for different inventory products that were slower than 30 days or haven't sold past the year. So I think as a guide, you had this inventory holding period 66 days. So yeah, I think 30 days is fair to start, or even 45 days would also work. And then, of course, what you are doing is now literally comparing the selling price of a product to its good in the inventory. And your aim is to compare. This is your main aim. You need to arrive at this point where you are comparing the cost with the net realizable value. Then, of course, there is the question of cutoff, right? So typically, all auditors know that on the last day at stock take, you will take the last goods received note and the last goods dispatch note, because we want to ensure that only, if you like, review a sample of goods received notes before and after the year end to ensure that only goods received before the year end, right, are included in the year end closing inventory, and that goods received after the year end are not. Seems pretty obvious, but it's important to make that note. And goods dispatched pre-year end are no longer in closing inventory. So if the goods have been dispatched pre-year end, that's really important to do that. So we're trying to ensure that we don't have this overstatement there. Inventory, existence, and accuracy. Existence and completeness we do when we go for the stock take, right? So we literally, for existence, we will look at in terms of directional testing, we will look at the actual inventory listing and the sheets on our system, and literally agree that to where we see them. Say, show us that piece of, I can see this saying on the inventory sheet that you have 10 pairs of shoes in this brand. Where are they? Go along and you look at them. So they do exist. You also want to test completeness, where you go floor to sheet, where you just decide that I want to see where I see those shoes over there. Show me where they are on the sheet, something along those lines. I've also written here, yeah, so in terms of accuracy as well, review a sample of inventory pieces on the list, right back to the order and invoice for accuracy of quantity and cost valuation. Right, so they have a new system as well, and it says here that I think, like any new system, the process is about observation and inquiring and documenting. So any new system you get, anytime you see anything about a system, what you want to understand is the system. So you want to show the examiner that you understand that you could do this either by flowcharts or narrative notes. Um, that's your first thing. So just try and understand, obtain, and well, that's the first thing. And I've written here, obtain and review the documentation. You could just have written, you can write, listen, obtain documentation as to how the system works and how it was implemented, and whether any exceptions or whether any issues. Just try and have an understanding, full understanding of how the system works. Um, and you can possibly walk through the system here. So you can actually have a little walkthrough depending on the system. But here we're talking about a stock take system. So you want to, in the end, do a walkthrough from start to end to see how it actually works. That's what with stock take, because this is a perpetual inventory. So what they're basically saying here is that there's 12 months in a year. What they're going to do is they might have 12 lines, and they will count the stock take of each one line each month. But by the end of the year, they would have counted 12, the 12 lines. They're not going to count all 12 at once. That's the point. So that's why it says attend a stock take. So you're going to one of the stock takes during the year to observe the controls, because a stock take is really a controls test, right? You're really going along at the stock take to observe controls, and if you're comfortable with the controls, then you're comfortable with the completeness and the existence of the inventory. That's the point with this. So again, I've written here that we're trying to ensure the controls prevent double counting or any errors. Um, so let me see. Yes. So the next big point, I think, is that typically at these events, there will be exceptions. There will be stock that needs to be written down, and this inventory system will need to be updated. What is the process of dealing with this? Dealing with this adjustment. So yeah, that is the question on question 16. It's a good one to have in the bag and just be comfortable with inventory systems. So just work through making sure you can write down a good number of these in case they come up. Okay, that's question 16.